While the market is still down over 17% year to date, if we zoom in right here, we can see that there has been a slight jump in the market over the past couple of weeks. If you watched one of my more recent videos on what stocks I bought during the recent market downturn, then you know that I took advantage of this opportunity to buy great dividend paying companies at good prices. While a lot of the companies that I bought back then are now trading at higher prices, I'm still continuing to find dividend companies to add to my portfolio. In this video, I'm going to be analyzing 3 of the stocks that I recently added to my dividend portfolio. I believe each of these stocks will help me attain my goal of one day being able to live off of dividend income. If you'd like to be able to download the spreadsheet used to analyze these stocks, then you can head over to my Patreon page at the link in the description. I'd also like to say thank you to Southern New Hampshire University for sponsoring this video, but more on that later. The first stock we're going to be looking at that I have added shares of is actually a new position in my portfolio, and that is CSCO, stock ticker CSCO, currently trading at $47.62 per share. We can see over the past year, they're down 12.78%. Now, there's a few different things that I like about this company, but they have a really nice starting dividend yield at around 3.2%. We can also see here, according to Seeking Alpha, they have a good dividend safety grade, a good dividend growth grade, a good starting dividend yield like we just saw, and pretty good dividend consistency. They've been increasing the amount they pay in dividends for about 11 years now. So we're going to be jumping into my stock valuation spreadsheet to see if we can calculate the intrinsic value of this stock along with our other stocks. We'll be looking at things like Graham's valuation model, a discounted cash flow model, a multiples valuation, and a dividend discount model. So let's go ahead and jump over to our stock screener. Like always, if you'd like to be able to download any of my spreadsheets, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and we will plug in the stock ticker for CSCO and hit enter, and you can see all of this data is going to automatically load in. Now we're currently looking at a 600-day change chart. Let's go ahead and zoom in a little bit, make this a 365-day change. So you can see a pretty big drop off in the price over the past year. Now, like I just mentioned, they currently have a dividend yield of about 3.2%, so that's a pretty decent starting yield with a payout ratio of about 50%. If we come down here, we can see analysts currently have a target price of about $55 per share, a decent bit higher than that current trading price. The beta is 1.00, so the volatility should be that of the market, and we can see institutional ownership is decent for this company at about 75%. So let's go ahead and jump forward, and the first valuation we'll look at is going to be Graham's valuation. So let's go ahead and zoom in. But this is a valuation model invented by Benjamin Graham. We can see the formula he lays out for us right here. So we're going to take things like the earnings per share and plug that in. We are going to apply a growth rate projection and the current yield on AAA corporate bonds, which is currently sitting at 4.8. So when I plug all of these in, you can see we come to an intrinsic value of about $36 per share, which is a bit lower than that current trading price. But let's go ahead and move forward and we'll look at our discounted cash flow model. And this is something that I really like about this company. But in order to perform the discounted cash flow analysis, we need to project a growth rate to the future free cash flows. So you can see I plugged in the historical free cash flows for this company so we can see our year-over-year growth rates. And while the free cash flow hasn't grown at a very rapid rate, you can see that's partly due to a pretty large decline over the past year. But moving forward, I'm projecting a growth rate of about 5%. I think historically speaking, this is a good estimate, as well as analysts agree with me. So I'm projecting that 5% future free cash flow all the way through the year 2030 and to the terminal value, which is the sum of the future free cash flows past the year 2030. I then took the present value of those future free cash flows and added them together here, added their cash and subtracted out their total debt to find their equity value. Once I had that, I divided by the number of shares outstanding, and I came to a discounted cash flow price per share of about $68.70. That's quite a bit stronger than the current trading price for this company. Now let's go ahead and look at the multiples valuation, but first, I want to say thank you to Southern New Hampshire University for sponsoring this video. As someone who graduated with a degree in finance, I understand how important the skills of finance degree can be when seeking out your dream job and also better understanding how to utilize financial tools to meet your investment goals. If you feel like your experience is holding you back from pursuing the career and increasing your income to the level that you want, then I'm excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online finance degree offerings in the country. In this program, you'll learn how to develop financial plans for clients, explore domestic and global economic environments, analyze financial statements to forecast and meet organizational goals, use methods to make sound financial decisions, and apply compliant ethical and legal practices. This program will prepare you for a variety of roles, such as financial analyst, professional banker, account manager, risk analyst, or financial consultant. Plus, if you choose the financial planning concentration, you'll be well prepared to become a certified financial planner. SNHU is radically affordable. Their online tuition rates are some of the lowest in the nation. When you request information, a real person will hop on a call and discuss how the program can benefit you personally. Go to snhu.edu/dividendology at the link in the description to see what the current average annual salary for a financial analyst is and to request free information about the program. And the idea behind our multiples valuation is we should be able to value a company based on how the market is valuing companies that are similar in structure. So you can see we have a wide range of companies that are somewhat similar to CSCO. We're taking their stock price and dividing by the earnings per share to get the price to earnings multiple. We then take the average price to earnings multiple, multiply it by CSCO's earnings per share to get an intrinsic value of about $57 per share. Now, there's two things we want to note. That's actually pretty close to what analysts' target price was. So that's it's kind of something to take note of. Now, if we come over here, we can see the price to earnings for CSCO sitting at 17.23, while the average price to earnings of their peers, as we can see right here, is sitting at 20.92. So that's a little bit of an indicator usually that they may be undervalued by the market. Now, the last valuation model that we want to look at is one that's really important to me because I'm a value dividend investor. That's the dividend discount model, and it values a company based on how much they increase their dividends by and how much their dividend is currently paying out. So you can see I plugged in the quarterly dividend payouts here, so we can see how much they're paying out each year. And as of late, the dividend payouts have slowed a little bit. We can see we had a good year at 6% here, 2.86, 2.78, and 2.7. Now, I am being a little bit more aggressive with this growth rate just because I think they have the potential to increase their dividends by a little bit more in the future. So you can see I'm projecting a growth rate of 3.75 to the future dividends for this company. After a discounting rate of 8%, we come to a dividend discount model of $37 per share. So when we jump over to our output tab, we can see our four valuations: Grams at 36, multiples at 57, discounted cash flow, a very strong valuation at 68.7, and the dividend discount model at $37.11 per share. So this gives us an intrinsic value when we average all four together, $50.06. So when we look at the current price of $47.62 and apply, let's say, a 10% margin of safety, based upon this, our acceptable buy price is about $45.05 per share, which is actually about the price that I was able to buy in. You can see at its current price, we're getting the signal that it's not quite at the buy range. Now, there's a couple of different reasons that I did go ahead and buy this stock. Like I mentioned earlier, there's a lot of reasons. I like the dividend, I like the starting dividend yield, and I like the future growth aspects of the dividend and the dividend safety. I typically like to apply a little bit more of a margin of safety, but I do believe in the company long term, and this is one I've been waiting to buy for a while. The second company that I bought shares of in my dividend portfolio is a company that has been in a downward spiral all year long, and it's actually not a position I was expecting to add more shares to, but that's Verizon Communications, stock ticker VC, currently trading at $38.62 per share. If we come down here, you can see they are down over 26% year to date. They've had a few drastic drops over the past year. We can see here in April there was a big drop, and fairly recently in July there was a big drop, and it's continued to decline since then. Now, there's a few positive aspects about that we'll talk about in just a moment, but if you come over here, we can see this is also a company that has been increasing the amount they pay in dividends for 18 consecutive years, and they have 22 years of consecutive dividend payments, so that is a good sign. But let's go ahead and jump into our stock valuation spreadsheet, and we will come right here and plug in the stock ticker and hit enter. Now, like I said, there's a few positive aspects about it coming down this low. We can see over here, it gives it a dividend yield of 6.76%. That is a really good starting dividend yield, especially for a company that has a payout ratio of 55.6. I think this is a very safe dividend still. If we come over here, we can see analysts currently have a target price of $45.30 per share, and the beta is very, very low, so you shouldn't see a whole lot of volatility in this company. Now, moving forward and looking at Grams valuation, we'll go ahead and zoom in here. We can see everything we need to have plugged in is already there. We have our earnings per share at 4.6. Now, this is a very low growth rate projection. Verizon is not expected to grow at a very rapid rate, which is going to bring down this valuation a little bit. But after we plug in our current yield on AAA corporate bonds, you can see even with our low growth rate projection and the high number on current yield on AAA corporate bonds, we still come to an intrinsic value of $43 per share, which is a bit higher than that current trading price, which to me is a very good sign that this company may be trading at a discount. Now, moving forward and looking at our discounted cash flow analysis, you can see again, I'm projecting a very low growth rate for the future free cash flows for this company, even though they had a pretty large decline in the most recent year. So the 3.75% is the growth rate for the future free cash flows for the company. Again, we take the present value and add them together for those future free cash flows and add Verizon's cash and cash equivalents and subtract out their total debt, which is a fairly large amount, as you can see right here. That'll give us our equity value. We then divide by the shares outstanding, and again, we come to a discounted cash flow price per share of $47 $27.38, a good bit higher than that current trading price. Now, when I looked at the multiples valuation, obviously we have a good comparable in AT&T, and there's some other companies that are similar to Verizon, but I just don't think they're close enough in structure to Verizon to provide a fair valuation using the multiples valuation, so I'm not using this to calculate intrinsic value. So the last valuation we'll look at is the dividend discount model. So we can see here I plugged in the quarterly dividend payouts for Verizon so we can see how much they pay out each year. So the growth rate hasn't been very high over the past few years, as you can see, 2.2, just about 2% here, 2.1, and 1.9. So that's an average growth rate of about 2%. Moving forward, I'm projecting a growth rate of about 2.2%. After applying our 8% discount rate, you can see we came to a dividend discount model price per share of $45.11. And the reason that we're still getting a higher valuation than the current price despite the low growth rate is, again, it's going to be because of that high starting dividend yield, as we can see right here at 6.76%. So when we jump over to our output tab, we can see our three valuations: grams at 43, DCF at 47, and dividend discount model at 45. And when we average those three together, we come to an intrinsic value of $45.17. So if we come down here and apply a 10% margin of safety and hit enter, you can see the acceptable buy price for this company is about $40.65 per share, giving us a signal that it may be a good time to consider buying this company. I was able to buy in at a somewhat decent price, around $37 per share. Now, you do have to keep in mind, like I mentioned earlier, you shouldn't see a whole lot of growth in this company, but I do think it's trading a little below its intrinsic value, so I wouldn't be surprised to see it over the next couple of years jump up closer to this number right here. Not to mention, most people are going to be buying in because of that really good starting dividend yield, as we saw right here. But let's go ahead and look at the last company that I bought shares at. And the third company that I have been buying is actually a company that I covered in a stock analysis the other day, and that is Target, stock ticker TGT, currently trading at $158.02 per share. We can see year to date, they are down over 31.8%. Now, something that a lot of people don't realize about this company is they've actually been increasing the amount they pay in dividends for 54 consecutive years. That's pretty unbelievable, and it makes them a dividend king. So let's go ahead and jump into our stock analysis. We'll come right here and plug in the stock ticker for Target and hit enter. And we're currently looking at a 1200-day change, so you can see the huge run up and then the large decline. Let's go ahead and zoom in, make this 365 days. So right here, again, you can see the huge decline in share price. They currently have a dividend yield of 2.73%, so that's a pretty decent starting yield, but the payout ratio is just 27.8%, giving them plenty of room to continue to grow their dividend. If we come over here, we can see analysts currently have a target price of $178. Pretty good institutional ownership at 82%, showing a lot of confidence in the stock, and it has a beta of just 1.02, so the volatility should be pretty close to that of the market. But moving forward, let's go ahead and look at our first valuation models, and you can see we're looking at Graham's valuation right here. Pretty good earnings per share, really good growth rate projections from analysts, and the current yield on AAA corporate bonds currently sitting at 4.8. So when we hit enter, you can see we come to an intrinsic value of $169.59. A bit higher than that current trading price. Moving forward and looking at our discounted cash flow model, you can see the average growth rate over the past few years is about 20% for the future free cash flows, and that's including a huge decrease from 2020 to 2021. So moving forward, I'm projecting a growth rate of about 12%. That's in line with analyst estimates. I projected that growth rate to all the future free cash flows of the company, took the present value of those future free cash flows like always and added them together, took Target's cash and their total debt to find their equity value. After I divided by the number of shares outstanding, I came to a discounted cash flow price per share that is much higher than the current trading price, $283 per share. Now moving forward and looking at the multiples valuation, you can see the companies we're going to use right here. I'll show you how it works. We'll come right here, we'll plug in Walmart stock ticker and hit enter, we'll plug in Dollar General's and hit enter, and then we can plug in Kroger's and hit enter. And you can see all of this data is going to load in, and we can see the average price to earnings for these companies is sitting at 22.47. If we jump over to our stock screener, scroll down, we can see the price to earnings for Target is currently sitting at 17.94, a little bit of an indicator they may be undervalued. So when we take this average price to earnings, multiply by Target's strong earnings per share, we come to an intrinsic value of $198.01. Now the last valuation we'll look at is the dividend discount model, and while they do have a slow starting dividend yield, you can see that the dividend increases over the past couple of years have been astronomical. We have a 32% increase and the most recent increase at 20%, so that's an average growth rate over the last few years of 14.63%. Moving forward, I'm projecting a growth rate of 6.5, and after applying our discount rate, we come to a dividend discount model price per share of 230. So when we jump over to our output tab and see our 4 valuations, grams at 169, multiples at 198, discounted cash flow at 283, and dividend discount model at 230. When we average these 4 together, we come to an intrinsic value of $220 per share. So the current trading price is about 158. So when we apply a 20% margin of safety, for example, you can see our acceptable buy price for this company is around $176 per share, meaning now may be a good time to consider buying this company. Now, I think there are still a lot of short-term risk for this company, such as if interest rates are continue to increase, or if we were to see a market downturn, a lot of consumers are going to go to places that have cheaper products, such as Walmart, like we saw in our multiples valuation. So I do think there is short-term risk, but long-term, I really like this company. I think we're going to see really good free cash flow growth like we saw on our DCF, and I think we're going to continue to see really good dividend growth as we've seen over the past couple of years. So that's one of the reasons that I have added them to my portfolio. But there you go. There's 3 companies that I've added to my dividend portfolio over the past few weeks. Go ahead and let me know what you think of these companies in the comments down below. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.